This business cannot give you anything. That you understand. Hardly something we can earn from this. When I used to tell him I want to do international CFA, I knew one thing, that I have to come into teaching, so I need to do more courses. That was my idea. So he, you know, at that time he sold his MRF ka shares at around 9,000 rupees. Just for me to complete my studies. This is the sacrifice of parents. We don't understand. So I knew that I don't have a backup. I am my own backup. I realized that. Because if I do something in life, then I can achieve something. So from that stage of life where you don't see much of life, you trust me on this, till the time I went to college, I did not even know what CCD and barista are. When I see the current generation, no, how they talk lounge, clubs, bars, we did not, even we used to do everything, but we used to do some other place. we did not have the money. We did not have the guts of going to these places. Arre, where is the money? Where is the money? Money kahan se aayega? You understood what I'm saying? So I said, I'll play cricket after that. My father said, okay, you do it if you want to play. I played in one club. I was good with my cricketing skills. I then started thinking I'll become a cricketer. They earn so much money, this, that. Then I told my father, I think I should play in 2 clubs. He said, okay, you play 2 clubs. You played 2 clubs. That gave me an excuse of not studying even further. So I stopped studying. I started focusing completely on cricket. Then in class 8, I failed. In the entire class, only 4 people failed in 400. I was one of them. Then my father said that, forget about it. We are a middle class family. Hardly anybody from Bengal has gone. West Bengal I come, no. Hardly anybody from West Bengal has gone in Indian cricket team till now. Only Saurav Ganguly has got a chance in all these years. You for sure will not get. You come back to studies. Then I had to quit my cricket also. Then I came back to studies after that. So journey is difficult. But once you go to that stage of your life, when you look back and you start feeling it was all worth it, yaar. It was all worth it. Because when I look at some of the question papers, or I see you people doing the hard work, I think, yaar, how did I pass, yaar? Seriously, I don't know. Some magic was done by God. So if we believe in karma, if we keep doing the hard work, it will happen. But you have to keep believing. One good thing is that in our times, distractions were less. Now distractions are too many. You are sitting in a CA final class and you do FNO. Arey, I'm not trying to say something negative to you. Just trying to see the gap between the generations. I did not even know that you have to open a demat account, because if you open a demat account, paisa kahan se dalenge? Where will money come from? So that is the difference between this generation and that generation, and you will have to just make sure that you clear your exams, then you go for a good job, you keep progressing over there. I know people who have worked hard and they have made a very, very good life for themselves and for their families. When you study good, no, you don't change your life. You change life of your parents also, your kids also. The environment starts becoming very positive. Today, what do you think can be a biggest success for a person like me? What can be the biggest success? When my parents come back to me and tell me that you did well in your life. We are proud of you. We are happy with the kind of life you have given us at the age of 60. Then the emotion which runs in you, then you don't need any other motivation. You don't need. Have you ever seen me coming to this class and like, oof, padhana padega? It'll never happen like that. The day it happens, I'll stop teaching. Because God has given so much that I am always thankful. Oh, I have this life. The first house where we used to stay. In this room, you can cut out 4 houses like that. You just imagine what I'm saying. This size of this classroom, you can cut out 4 plots of that size. 4 houses of mine can be accommodated, where I spent 23 years of my life. 23 years. And when I was doing CA final, you know what my father came and told me? Your mom is telling me to buy a new house, but I don't have the guts to buy. What should I do? I said, you buy. I'll become CA, we'll take care of it. Because I was writing exam, my brother was writing. My wife was also writing, but then she was my girlfriend. So we three cleared on same day. Me, my wife, my brother. We all three cleared on same day. And from there on, the life changed. Then I told my dad, now there is no tension. I'll go work. But I am born to give tensions. Then I told him, I don't want to work. Then I told him, I don't want to work. So what will you do? Why did you do so many courses? Arey, that is for teaching, no. So if people come and ask me, oh, how do I stay motivated? Arey, your biggest motivation that you have your everything in your body is intact. You are blessed. You can attend these classes. You are blessed. You have a bike. You are blessed. You have parents. You are blessed. They can afford your studies. You are blessed. You have so many blessings on your side and still you are looking for motivation. Think about it. So you see how many things would have gone. You don't think I am talking spiritual. I am not Sadhguru. But you have to start believing in all this. Then you will understand the real meaning of life. Come out of Instagram. Instagram is to show what you don't have. You realize this? Come out of that. The more the insecure people, the more they come on Instagram. Very rarely I have seen good people coming on Instagram for doing something. See, I have to be on Instagram because I need to let people know that I'm doing teaching. That is a different thing. You can't be an influencer. Everybody has become an influencer nowadays. So if you someday know you feel demotivated, you do one thing. You sit in a room, light up the room, sit, pick up a piece of paper and just try to write what all things you got in life. How many things would have gone correct for you to have come this far in your life and you still need motivation? Which family would you be born to was not in your control? What if you come from a family where your education cannot be funded? Think about it. No money is there. How can we teach you? No money is there. Your parents say this. And they are also correct. They are brutally true to you that we don't have money to teach you. We can't afford your education. Then what would we do? But right now where you are one step away from your success. यहाँ से U-turn नहीं है. U-turn नहीं है. There is only one way. You have to go ahead and you have to clear your exam. Because on the other side, a very beautiful life is waiting for you. That you have to see how much can you procrastinate? How much can you defer this? But when you know you have to do it, then why defer? Set targets. I set a target. I told my dad, you take a loan. Why did I say that? Because I thought that will work as a motivation for me. Because now I know a sword is hanging on my father's head. I have to do something. I cleared all my exams at first go. I didn't clear CA final in one go. I didn't clear. All exams. I was doing everything parallelly. I cleared everything. CA final, I took the pressure. I couldn't clear. I got 38 in DT, 34 in ISCA. Group 1 cleared, Group 2 fail. Costing pass, IDT pass. Next attempt I gave, I said, Dekhte, now we will see. That is when I got this 78, second highest in DT all across India. The same person, no? Same person only, no? First time 38. Next time I got 78. 60 plus in all 4 papers I got. All 4 papers. So some setbacks are good in life if they motivate you. Okay. That's why I tell you that you form groups, have friends who think in the same direction. It helps big time. I am thankful to my friends even today. Because of them, I could do a lot of things in life, which otherwise what happens when we are all alone, no, we generally don't see what I am capable of. But sometimes, no, people around you make you understand what you're capable of. You need to have good, genuine friends for that. The ones who push you up, not push you on the sidelines. Okay, we will start with derivatives, guys. A basic discussion we will do today. We will be able to do a little more than that. See, just listen to what I'm saying first, okay? The first derivatives are financial instruments. Okay? Derivatives are financial instruments. The first reason why derivatives were introduced was for the purpose of hedging. The first reason why derivatives were introduced, the purpose was hedging. That is, you have some risk in the business, you want protection against it, so there is a financial instrument available to protect against that. That is derivative. The best example is forward cover. A forward contract is also a derivative. In fact, if you remember, I told you, a forward contract is an OTC derivative, over the counter. You remember that? I told you over the counter derivatives are offered by banks and the contracts are customized. Customization is in two aspects: maturity, lot sizes, quantity. You remember that? So market has given us some instruments which can be used by you for the purpose of hedging yourself. But then you see, people are very smart. They thought, if I don't have an exposure, but I have a belief, can I still use derivatives? The answer is yes, you can still use derivatives. Which means, idea was to introduce derivatives for hedging and protection, but then people started using it for something else. What is that something else? Speculation. There can be innumerable type of risk in business, innumerable. But your institute told you that you focus on these risk factors. These four. These four are your primary risk factors which we are going to discuss in this chapter. Number one, interest rate fluctuation risk. Interest rates going up is a problem for somebody. Interest rates going down is a problem for somebody. If you take a housing loan, guys, housing loan. You take a housing loan for at least 10, 15, 20, 25 years. Max to max, I think India banks will offer you 30 years of housing loan. Max to max. Normally people take 25 years. Housing loans never come at fixed rate. They come at floating rates. Which means what they say, if the market rate will change, then your loan rate will also change. So when you take a housing loan, what are you worried about interest rates going up? You will be happy if there is any instrument which can give you protection against interest rates going up. You understood what I said? Derivatives chapter, guys, I want you to understand very conceptually, and it is much more interesting compared to Forex. I hope you people liked Forex also, but you will enjoy derivatives a lot because there's so much to learn and so much related to the real markets. So whenever I talk about any risk, as a student, first of all, you should know who is afraid of that risk. So if I ask you, who is worried about interest rates going up, what would you say? Sir, anybody who is going to pay floating rate will be worried about interest rates going up. Hello? Okay. I invested in the bonds, but the bonds are floating rate bonds. I invested. So I thought that rates will go up. Bonds carry coupon, but there are floating rate bonds. Floating rate bonds will pay you according to the market prevailing rate. But actually, what are you worried about? Rates going down. So a floating rate bond investor is worried about interest rates going down. A floating rate house loan, if you are taken, then you're worried about interest rates going up. Are you understanding what I'm saying? Exchange rate volatility risk. I need not talk about this because it is covered in Forex. Importer foreign currency borrower, both have foreign currency payable. Payable is a liability. They both are afraid of liability going up. That is, they both are afraid of foreign currency going up. Exporter, foreign currency investor, they both have receivable. They are worried about foreign currency going down. One way to hedge is forward cover. Now we will have to learn more methods of hedging. Third category of risk, fluctuation in prices of raw materials and finished goods. You know, Indigo Airlines, Interglobe Aviation, 30% of their raw material cost comprises of crude oil prices. 30%. Fluctuation in price of raw material. If crude price will go up, their cost of operating the flights will go up, their profits will come down. So what are they worried about? Crude oil prices going up. Fluctuation in prices of raw materials and finished goods. A wheat manufacturer, wheat producer, farmer, he produces thousands of quintals of wheat, but suddenly there is a dip in demand. Maybe because supplies are too much or because exports are restricted right now. What is he worried about? Prices going down. Business of gold. Suddenly gold prices crashed. You are holding on to a lot of gold because you are a retailer, wholesaler. What are you worried about? Gold prices going down. Are you able to understand all these things logically? Next, equity or bond portfolio exposure. Very simple. I have a portfolio. I have taken a portfolio. Portfolio is always long, no? A portfolio cannot be short. Portfolio is long only, no? I have a long portfolio. I have a portfolio of 2 crore rupees. Suddenly COVID happens. My portfolio can go down by 10, 15, 20, 30%. Nobody knows. Anybody who has a long position in a portfolio, means he's bullish. First you see what he's thinking. Why did he create a portfolio? Because he's bullish on the shares. And what is he worried about? Prices going down. If you take a short position, it means you're betting on downside. What are you worried about? Prices going up. So your institute says how derivatives can be used, we will talk later. But what risk are you talking about that derivatives are needed? What risk are you talking about for which derivatives are needed? So we understand there are 4 types of risk. 4 types. Interest rate fluctuation risk, exchange rate volatility risk, prices of raw materials and finished goods, and your holding in financial assets like equity and bonds. Are we clear about it? See what is written. Companies require risk management tools. This is where derivatives will come in. Risk management tools to handle these risk factors efficiently. Failure to do so can put the organization out of competition. This is on page 93, guys. Okay. Now we have given some space over there and we will explain every risk factor. That's right. A. We're writing over here A. Page 93, okay? That space is given on page 93. There we have to write. We are just trying to explain the risk from different category of people. A home loan borrower will be worried about interest rates going up. Will be worried about interest rates going up. A floating rate bond investor A floating rate bond investor will be worried about interest rates going down. Point number B. Next, they're saying exchange rate. Foreign currency payable, afraid of foreign currency appreciation. Foreign currency receivable, afraid of foreign currency depreciation. Foreign currency payable, afraid of foreign currency appreciation. Foreign currency receivable, worried about foreign currency depreciation. C. Airlines company will be worried about airlines company. This is third one. Third one is what? Raw material and finished goods. I'm giving you one example for each of them. A, B, C, D category. A, B, C, D, we are writing risk exposure. If you first understand what is the risk, only then you can find a solution to tackle that risk. No, that is why we are first studying risk exposure. Then we will study what are derivatives. Understood? Airlines company will be worried about crude oil prices going up. And wheat producer, any kind of farming that you do, wheat producer will be worried about prices going down. Next, D. An investor will be worried about his portfolio going down. An investor will be worried about his portfolio going down. An investor will be worried about his portfolio going down because of market fall. An investor will be worried about his portfolio going down because of market fall. An investor will be worried about his portfolio going down because of market fall. Full stop. If we have a short position, we will be worried about price going up. If we have a short position, we will be worried about price going up. Now, we understood what is risk. Now what happens? Financial markets play a vital role in providing many instruments that facilitates management of risk. The question is, how many types of derivatives are available that can be used to tackle the above 4 types of risk? So we have 5 different derivatives available. Number 1 is forward contract. When you see forward contract, you feel happy because you have already studied that. Next is financial swaps. Third is future options. Cap floor collar. You remember FNO. FNO stands for futures and options. Okay. Now see, C, D, E, they are exchange traded. A, B, they are OTC. Futures, options, and cap floor and collar, they are exchange oriented, which means they will have standardization, which means their margins will be very strict. But A and B are customized contracts because the bank is giving you. Okay, please write C, D, E, E, T, exchange traded. And A and B are OTC, over the counter. Below that we have some space, we'll just write a few lines about them. exchange traded. Exchange provides the contracts. On the other hand, banks act as market maker. Banks act as market maker. Standardized contracts. What does that mean? Fixed maturity and lot size. Fixed maturity and lot size. Standardized contracts, fixed maturity and lot size. On the other side, customized contracts. Next, point number 3, margin requirement is strict. Anything which goes through exchange, no, it is same for everybody. There is no preferential treatment. That is why they have standard rules. Whoever wants to come and trade in this market, you have to follow the rules. As simple as that. But banks, if they know me, I am a good client to them, they may cut down the margin requirements for me. So where do you think default risk is higher? Obviously banks, because they are not very strict. That's why default risk is high in banks. When Vijay Mallya ran away from the country, he did not take anything from the exchange, no. But he took a lot from the banks, no. Remember like that, okay. Point number 4, exchange, right? Default risk is very low. On the exchange side, default risk is very low. Default risk is very low. On the other side, OTC, default risk is relatively higher. Default risk is relatively higher. Next, come to the next page. You remember I told you one thing. If it is equity share, that I'm talking about, then in this equity share, I can trade in 3 different ways. Spot market, that is delivery based. I can do futures. I can do options. Okay, futures are exchange traded. Now you understand that. Okay. So spot delivery based market, let's say the price of Infosys is 1650. The same thing will be available in the future market also. The price in the futures for Infosys, which one do you think is correct? You just let me know. 1660? 1660? No, you have no idea. But you still told me 1660 and that is the correct answer. Because you're trying to do method of elimination. You're saying, sir, same Infosys, just because it is available in 2 different markets, how can there be such a drastic difference in the price? So you know these 2 are wrong. this future on Infosys is basically deriving its value from the spot market only. That is why they are called derivatives. Because they're deriving their value from something else that is called the underlying. Market is giving you a option. Market is giving you, okay, let's not call option, otherwise you will think about this option. Market is giving you an alternative medium to trade in the same security on a different platform. So if you trade on the same Infosys in futures market or options market, price cannot be hell and heaven difference. So the price of Infosys in the future market will be derived from the price of Infosys in the spot market. So the price may not be exactly same, but has to be very close to 1650 rupees. So it can be 1655, 1660, 1645. That much is fine. But you think it cannot be 1750, 1800. Because future is a derivative which is deriving its value from the underlying asset. What is underlying asset in this case? It is the price in the spot market. Hello? You don't have to go this far. Actually, you already know this. What is the formula of IRP, guys? F is equal to S into 1 plus IA divided by 1 plus IB. I am asking you one question. Why did you write F is equal to S? Because forward rate is a derivative which will derive its value from the price in the spot market. So spot market price becomes underlying and forward contract becomes a derivative. Understood? That's why they are called derivatives. You will see some people will call in style derivatives. What are you studying in class? I'm studying derivatives, you know. They take the literal meaning of it. Because they're deriving their value. So they say derivatives. You understood? Okay. So derivative is a financial contract which derives its value from some underlying asset. To prove this, think of IRP we discussed in Forex. Fingers crossed, hope you remember. I have written, no, I have written over there. That's I'm reading. As per IRP, F by S is equal to 1 plus interest rate of rupee divided by 1 plus interest rate of dollar, or F is equal to S into something, which means the forward rate is derived from the spot market. Okay, that is why you see when spot rate was 62 and 3 months forward rate is 62.5, you can say one thing clearly that this 62.5 is not a coincidence. It has been derived from this rate only. Correct, no? Forward rate is a derivative and it derives its value from the spot rate of 62. Understood? So how do you now talk? If I ask you, what did you learn about derivatives so far? You will say, sir, every business has some risk. We study 4 major risk categories in our class. One is interest rate fluctuation risk. One is exchange rate volatility risk. One is raw material finished goods prices fluctuating. And last is, equity and bond portfolio. For any financial asset you are holding, you are worried about the price fluctuations in adverse direction. So what to do? Okay, sir, then we can use derivatives. For what purpose? For protection. So basically derivatives were introduced for hedging? Yes, sir. They were introduced for hedging. How many types of derivatives? 2 types. Exchange traded. They have 3 categories. Futures, options, cap floor collar. And then we have OTC, where bank is the market maker. Forward contracts done in Forex. Apart from that, we do one more thing that is called as financial swaps. Some forward contract is still left to be discussed. That is called as FRA, forward rate agreements, which we will cover in this chapter. Okay. Now, derivatives were primarily introduced to hedge against the business risk. However, today derivatives are mostly used, or I can also say abused, for the purpose of speculation. In Hindi, we call it as fatka, that is gambling. Okay. If used efficiently with good money backup and proper strategies in place, they can help you make quick money. However, if used recklessly, it can be a sufficient enough reason for you to quit equity markets as a whole. So why are you saying that? I'll explain you. And if I need any help, I'll call Suhas also to help me. You can explain better than me, I think. Today, you are looking very sad. What happened? Huh? HDFC is troubling you, or OFSS is troubling you more? We used to do a share. Today that share is up by 30%. OFSS. 30% in a day. Just because they posted good numbers. People are celebrating. Okay, now we come to futures. Why did I say that if used recklessly, they can be very dangerous? That we will understand now. Okay. We'll continue with the same example, guys. Infosys. Spot Infosys price is 1650. Okay. Let's say you have 5 lakhs of capital. You come to me and tell me, sir, I am new to the equity markets. I want to start doing trading in the market. And now listen very carefully, guys. Okay. So if you have any questions, you ask me at the end. Let me finish the entire discussion first. We are trying to understand how futures work. And once you understand futures, then your platform is created. Then options will also work on a similar lines. So you will understand it easily. Okay. So you come to me and tell me, sir, I am interested in investing in equity markets. So what I thought when I was doing some research based on your SFM class knowledge, I thought Infosys is a very good buy at 1650. I said, good, yeah, even I like it. So you said, sir, okay, I have opened a Demat account in Zerodha. Can I go and buy Infosys? I thought first trade I should ask you and do it. I said, yeah, you can buy. So what you decided, one of you please be very active with the calculator, okay? I would need help. So let's say 1600 is the price, 1600. So you thought, okay, 1600 is the price. Let me buy 300 shares. How much is needed? 16 3 48, 4,80,000 is needed. Huh? Hello? You remember, now try to visualize a statement in front of you which has portfolio, positions, fund. Your fund will show 20,000. Now, after this trade, 20,000. Positions will show. Positions will show Infosys, T+1. Tomorrow it will appear in your portfolio. Correct? 300 shares bought. Okay. Now 300 shares bought. And let's say 1 month, 2 month, 3 month, 4 months, 5 months, it was there in your portfolio. Then you saw the price has gone up to 1750. Which means you are making 150 rupees on 300 shares. Which means total you are making is 45,000. When you called me up and told me, sir, I think I'm getting close to 10% return on my investment. Should I book the profits at 1750? I said, yeah, you can book it. If you don't want to hold it for very long, then it's good that you book the profit because the profit amount is also decent. So you can take it. He said, sir, okay, I'll book it. Are you clear about it? Okay. Next, what happened? So the money gets free. Now you have 5 lakh plus 45,000 in your Demat account, which is 5 lakh 45,000. Okay. Next, you come to me and tell me, sir, I want to buy Page Industry. The price is 37,000. You do your maths. Buy 37,000, 10 shares, 3,70,000 gone. Correct? If I buy 15 shares, how much is needed? See, 37, 18, 53, 530 something, right? 530, 540 is needed. Think, sir, only 15 shares. 5,40,000. Then you tell me, sir, can you just explain me how futures would work in this case? I said, why are you doing this? You did one trade in your life, you made good money. Why do you want to go into futures? No, sir, just for understanding. I won't do, I assure you. Just for understanding, please explain me how futures would work in this case. I said, okay, I'll explain you, no problem. So what we did, we found that spot market price for Page Industry is 37,000 and future price is different for Page Industry. Then I ask you, what is the price of future? You do one thing, you just open the Zerodha app and you tell me what is the price of future. No, you don't have to open it. I'm just telling you, think like that. So you opened your Zerodha app and you found something interesting that right now we are in the month of January. So there is January contract, there is February contract, and there is March contract. And the price is like this, 37,100, 37,200 and 37,250. Okay. Now you ask me, sir, why they have given month-wise? Then I tell you, you don't remember in class we studied that futures are standardized contracts and they come with fixed maturity. So future, if you want to do, you have to do it either for the month of January or for the month of February or for the month of March. Which means they come with exact maturity. And there is a lot size also. The lot size in this case is 15. Got me? 15 is the lot size for Page Industry. So, sir, how do we read February contract? It means if you buy the future of page industry for the month of February, then before last Thursday of the month of February, if you take a long position, you have to do your position reverse. Before that last Thursday of February. But sir, what about cash market? Arey, cash market, to you are the owner of the share, no, because you paid 100% for it. So you are the owner. How long can you hold? Infinity? The problem is you won't live for infinity. That's why you have a nominee. After you, your nominee gets the shares. But can somebody define how long can you keep the share? You can keep it till the company is alive or you are alive. You can keep it. But future you can't keep. But so what if I want to keep after February also? Then you do one thing. You February position you square off and you create a new position of March. Arey, February F plus. Then by last Thursday, February F minus. You create March F plus immediately. That is the only small thing you have to do. You roll over your position. This is called rolling over. So you said, sir, this is looking interesting. Two things are defined. Maturity, Jan, Feb, March. Quantity, lot size. 37,100 into 15. If I take January contract. 5 lakh? 56,000. Okay, approx. 5,50,000 approx. What money you have in your demat? You become sad. I don't have money to buy. I said, you don't have to be sad. You said, why, sir? I said, first you try to click on buy and see what margin is needed. Then you see that the margin needed to buy this contract is only 1,50,000. And you are like, oh, how did that happen? Because you only have to pay 1,50,000 for an exposure worth 5,50,000. And then you are astonished. Malav, you are showing that you are astonished. From inside you are very happy. Because it is feeding the greedy devil inside you. So the question is, how does this work? Now the point is, if you take ownership of shares, then you pay the 100% money and you get ownership. You don't go to an iPhone showroom and say, I give you 10,000 today. After every month I'll come and give you 10,000. Trust me, I'll come. You give me the phone today. It doesn't work like that. Same thing happens in delivery market. You pay the 100%, it goes to your portfolio, you keep it till you want. Here you have no intention of buying. The intention is only to take a long position. You are not the owner of the company. You can't participate in the AGM. You have no voting rights. You won't be entitled to dividends. You won't be entitled to right issue. You won't be entitled to any bonus given by the company. No. All that you get is position. Now you understood why long position is called long position? Hello. I told you on day one, no, long, think of it like buy, but they are not same. I will explain later on. Why we can't call long and buy same. Buy means taking ownership. Long is only a position. That's why you say long position is similar to buying, because both enjoy the upside movement. Short position is similar to selling, because both enjoy the downside movement. Just because you are not getting ownership, you only have to pay margin. And the margin is how much? 1,50,000. So you said, this is beautiful. You only pay 1,50,000 for something which is worth 5,50,000. Okay, the difference, do they charge me interest on that? No, they don't. Oh, this is a blessing in disguise. Yeah, for the time being. That's how we all think. Now what happens from here? They do M to M, mark to market. So you do one thing. You said, sir, pakka, one trade only in the life. After this, we will never do. Okay. So January contract, you take F plus at 37,100. 37,100, you have taken F plus, long position. Bullish. And you're very happy because see, you got 15 shares in your account also. I mean, in your position. In your position, it shows one lot of page industry F plus, long position. And you still have 3-4 lakhs in your account. You feel so good. You have the same number of shares, but the money is still intact in your account. So you have one long position at 37,100. It jumps up to 38,000. Every day what will happen? M to M positive, M to M positive, M to M positive. The money keeps adding to your account because you are gaining, but it is an unrealized profit. How much is your profit? 900 rupees. Lot size is 15. How many lots you have taken? 1. So do it 900 into 15. 1,35,000. 35,000. 13,500. 13,500 is your profit. Then it goes to, let's say, 39,000. You're keeping it by month end. By month end, results came out or something happened and it went up. How much is that now? 28,500. What are you supposed to do? You do F minus and you make 28,500. What was your exposure? 5.5 lakhs. But what was your actual capital involved? Only 1.5 lakhs. You make 28,500. That's how futures work. So let's talk the other way around. HDFC Bank. F plus at 1,700. Just 2 days back. 2 days back. 1,700 rupees. 2 lots taken. Lot size is 550. Jan end. Contract is Jan end. Normally, how much will you have to pay? 1,700 into 550 into 2. Do it. 18 lakhs you have to pay. And I'm not joking, all these lot sizes are for real, guys. 18 lakhs worth of stock you have bought, and your margin requirement would not be more than 3 lakhs, I think. 3.5 lakhs, right? It won't be more than that. Understood? So you have taken 2 lots with an exposure of close to 18 lakhs of rupees, but you're only paying 3 lakhs. You know what is the danger that you are running in this? You are eligible to take a trade, but you are not capable of keeping the trade. Because how much is your exposure? 18 lakhs. If there is a fall of 20% in the script, which actually happened, no? 10-15% it fall. If it falls by 20%, it is 3.5 lakhs. If you don't have that much money with you, how do you tackle this position? Generally, people, why they lose money in this market, you know, they focus more on this. What they should be focusing is this. What is my exposure? 18 lakhs. You should focus on that. Rather than thinking what profits you can make, first you think, if of that exposure amount 20% is minus, can I still tackle that? That is the question to ask. Because from there, if the stock falls by 20%, for any reason on earth, 2 countries declare a war against each other, the results of the company are not good, the board of directors of the company have resigned, auditor has given a qualified report, whatever be the reason in the world, COVID has happened, demonetization has happened, BJP government lost elections, whatever happens in the world, if the stock falls, you should first think in your mind, of the total exposure, what percentage can I lose? Because that is the mark to market. On this, if 20% falls, let's say the stock today is trading at 1,500, because that is the reality of the stock within 2-3 days. What is your M to M? 200 into 550 into 2. 2 lakhs, 20,000. You know what a broker will tell you? From your surplus in the account, they will keep deducting it. That much money they will keep deducting from your account, from your surplus money. That 3 lakh what you paid was enough margin to initiate a contract. Now from the price at which you took a position, any deviation, any change which makes you suffer a loss, that much money they want you to put. So if you have money back up, it's okay, you give. There's no problem in doing futures. I'm again saying the same thing. The problem is when we do things beyond our capacity. Good food can also cause problems, no? Think about it. Good food can also cause problems if you are eating beyond your capacity, no? Digestive issues can still happen on good food. It's not always the bad food which causes you digestive issues. This is a good market, I'm again repeating. I have seen people doing magics in this market who have just listened to the advice I have given. They have not become greedy in the process. They have maintained this discipline. 1 trade, 2 trade, that's it. They have not gone beyond that. People have made money like anything because of the simple maths. Simple maths. You only pay 20 to 30% of the exposure. And you sit with the remaining capital. Small swings will happen. And you make money and go. But you need good capital. You come to market with 2 lakh rupees. One day M2M itself will be 1.5 lakhs. Where do you give from? No, I don't have. Then okay, you go back. Bye. And then you say this market is not good. Your approach is not good. If you have 2 lakhs capital, don't do FNO. Think about it. You come with good capital, then you sit in FNO and do limited trades. Because market is in nobody's control. Today, after 3:30 till tomorrow, now to even closing your eyes for sleeping becomes scary. Next morning you get up, ET notification comes. Bomb dropped, fire, this, that, new policy, new tax regime. Something happens. Gift Nifty is not a gift. It's not a gift because it keeps scaring you all the time. Understood? So this is how futures work. Only because you are allowed to take a position, that is why you only have to pay the initial margin, which is 20 to 30% of the total exposure limit. But if the position goes in losses, then they ask you to deposit the difference. That is called variation margin. The other beautiful side of it is when Nifty was continuously going up, somebody felt that this is too much here. Too much. I think this is wrong. Markets are going up like anything. So you try to do one thing. Nifty is an index, right? And index can also be traded. So you take Nifty F minus. Short selling is not allowed in delivery based market. If you sell also, you have to cover your position on the same day before 3:30. Hello, time to recollect your knowledge now. But in futures, you can short the position till entire January or entire February or entire March, which means you can sit with the short position for a long time. Like what I did when I thought 21,500 was crossed, no? 21,500 on Nifty was crossed. I thought before February, one time the fall in market will happen. So I took a February short position of Nifty. February. So when am I supposed to square off that position? Before last Thursday of February. During this while, sir, something can happen. Nothing. I took a short at 21,500. Suppose it goes to 23,000. Suppose. Which means Namo effect has taken over my sentiments. At 23,000, I start fearing Namo. At 23,000, if I fear Namo that it can go to 25,000, maybe at 23,000, I decide to square off my position by taking a reverse position, which is that I take a F plus. I need not hold till last Thursday of February. That is the maximum I can hold. But in between, I can anytime square off my position. You understood what I said? Or if I am thick skin, then at 23,000 I will short 2 more lots. This is what generally I do. I don't tell my trades to my dad also. He will get scared. But honestly speaking, you should not do too many trades. I tell people, but I am not able to follow. So I generally, what I do, I sell, and I only sell Nifty. I don't sell stocks. You should never sell stocks. I'm being very honest. I've never in my life sold stocks. Should not go short on stocks because you don't know what is the limit of stocks going up. You don't know. At what point you will say, अरे अब और नहीं चलेगा यार, हो गया. अरे how do you know? हो गया. Upside limit is what? Infinity. Downside limit is what? Zero. Why are you challenging infinity? You should not short stocks. Telling you especially, you should not sell call. Today, if somebody would have sold a call of Oracle, finished. You would be searching for some Ganges, right? To commit suicide. But that is for institutional investors, not for us. Generally, you are doing calls, so I am saying this. Call and put people who do, they have a tendency to sell the calls, thinking very smart. No, you can't do it. It's very risky. Never do it. Not even on Nifty and Bank Nifty. You seriously find some opportunity, you buy a call or buy a put. No shorting. It takes away a lot of money. It takes away. So what I did, like when I sold February month contract, it went up by 500. 500, lot size 50. Only one lot I did. 5,000 into 500 into 50 is how much? 25,000 gone. I could have squared off my position. Or I could have, on a higher rate, if I average a short position, I can do it, no? Then I sold one more lot. Then I sold one more lot at a higher price. I'm shorting it continuously, thinking someday it will come down. So it came down today. It came down, no? But I'm waiting for more fall. You have anything to ask, then you ask. But your concepts have to be super clear on this, super clear. If you have anything to ask, you ask me. Huh. Aha, clever boy. 3 lakhs is to initiate a contract. From 3 lakhs, even if 1 rupee it goes down, no. 3 lakhs you paid to take F plus at 1700. Now it becomes 1699 also, no. That 1 rupee you have to pay on 1100 shares. Because you have taken 550 into 2, 1100. So you have to start paying from every 1 rupee. You need to have fund balance. You can realize. Are you talking about a long position price drop or a short position price drop? Short position price drop is a realized profit. If I book it, it's up to me whether I want to book it or I want to keep it as unrealized. Okay, I'll give you example. Okay, we'll talk stock here. Let's say I am bearish on Reliance. Okay, 2700 F minus. It became 2600. How much is my profit? 100. Lot size 250. Total profit 25,000. It is showing as unrealized profit. But if I want, I can make it realized. No, I will take F plus at this price. It's up to me. You square off your position. You took F minus. You want to square off your position. You take F plus. This is what I taught you in the class. No. To square off a long position, you take a reverse trade. Go short. Last Thursday of the month of maturity, by default, you have to square off. But you can square off at any point of time. That is the price of future today. Spot market, futures. There is a firewall. If you initiate a trade on this side, you need to finish the trade on this side. If you initiate a trade on this side, you square off the trade on this side. Be very clear about it. You took F plus. Now you want to sell the shares in the spot market. Not possible because you don't have shares here. You only have a position. You have HDFC Limited future. Now tomorrow you file a case on the company. I was not invited for AGM. I got angry. I missed that lunch box. You are not entitled. You are not entitled for that. You are not a registered shareholder of the company. Your name does not appear in the register. You will not be entitled to dividends. There is a parallel market created for people who love volatility. Some companies bring their FNO segment, some companies don't bring their FNO segment. You understood? So every time I take a long position, there is somebody who's taking a short position. He will square off his short by taking long. I will square off my long by taking short. Is there a possibility that you wouldn't find the other side of the party? Generally, that happens with the longer maturity contracts. Like January, mostly you will get. February, little less. March, difficult to get. March, you will get if it is index. Because index has huge liquidity. Huge. Too many people have become crazy now. If you have 3 lakhs, your one position requires 1,50,000 of margin. They will deduct 1,50,000. The remaining 1,50,000 will show as a cash balance in your account. Today, if your M2M is profit of 10,000, that 10,000 will add to your cash balance. If there is a M2M loss of 10,000, your balance will reduce down to 1,40,000. What is over and above? You see, you are talking such nasty things in the class. You just see. You are scaring us, people like me and him who do markets daily. You are scaring us. He's saying, what if my balance is 1,50,000, but it falls by more than that in a day? Nothing. They will see generally what happens nowadays. Their systems are, the risk management systems are very much in place. You know what happens the moment you are left with only 5 to 10% of the final margin, they will by default square off your position. Auto square off. That is called auto square off. But earlier days, the technology was not so handy. So what happens, like for Yes Bank, when it fell for the first time, it went down like crazy. And people lost money like anything. Their balances were showing as minus 2 lakh, minus 3 lakh on FNO. Now after that, broker is going after them, please sir, pay. They're saying, come tomorrow, my account was in Yes Bank only. They have. On record, you want to hear? There are two benefits. The theoretical one, which all teachers will tell you. They want to keep volatility away from the delivery-based market. So they have FNO segment. Like you see, this room is there for teaching you people. Most of you are serious. 5% of the audience does not like studying, and they can't handle the other people studying. So we created another room where there is party going on, hookah going on, everything is going on. We told those people, you go and sit in the other room. So they are also happy, we are also happy. So you want to do all that, you please do it in the separate room. Same thing like that. You want to enjoy volatility in the market, you please go to the FNO segment. Now coming to the other question. This is again my own theory. Okay, not saying officially, but unofficially. I think the maximum benefit which companies, the companies which have it on FNO is for their own self-interest. You see how easy it was to make money on OFSS today, only if you had a brother or a sister or a friend or a friend's brother or sister working in Oracle who is going to publish that report. Just a click of a button, they know what they're publishing. And if you tell me, sir, today no insider trading would have happened in OFSS, I'll come and touch your feet. I'll say, goddess, God or goddess is there inside you, because you see only good things in life. You just see there is a huge volume today, but they won't understand, no. People who don't trade, they don't understand. You saw the volume, I saw the volume during break. I saw it during break. Last 3 days, 1 lakh, 2 lakh, 3 lakh shares were traded. Today, 20 lakh shares are traded. Generally, what will you do if you see the share in the morning opening 10% up, you try to back out from that share. In this share, continuously buying has been done. How is that possible? How is that possible? Then if I tell people insider trading is going on, oh, no, that's not possible. You didn't learn your lectures properly. You don't know how world is running. I think FNO segment is primarily feeding onto people itself who know everything inside out of the company. What SEBI does? What SEBI does? You are not allowed to trade in the shares of your own company. Okay, my brother's friend's girlfriend will do. Now you do what you want to do. How do you stop this, man? This is all bullshit, right? How do you stop this? You can't stop this. You have rules and regulations which are meant to be broken. So I personally don't see any other reason. There are only two reasons. One is to cut down the volatility. Second is to do a lot of insider trading on your own script. And the best part is you don't need money to do all this. No? You need limited money. You have it. You do it. From 25% today, the circuit, from 25%, the next circuit happened at 30%. Not the circuit exactly. The next big jump happened at 30%. My question is only this much, at 25% upside also, who has the guts of buying it? Am I asking a wrong question, guys? Now you people are matured. You answer this. Now you know what will happen. Some innocent people get trapped. Because what do you think? Today it opened a gap up at 6,000. Example I'm giving. 5,500 it opened. You are thinking the journey of upside has started from 5,500. What you don't know is from 4,000 to 5,500 has already happened only in last 1 month. Insiders have got into, you think the results were prepared today only and published today. Results are prepared, no, for last 15 days, 20 days. Since then the accumulation has already started. From 4,000 to 5,500 somebody has already enjoyed the cream. What you are eating is just a melted ice cream now. And now somebody who wants to get hold of it will only get hold of the cone. somebody very studious will sit back home today. Very good results. Company has great future. Tomorrow morning we should buy 100 shares. Pakka. You buy 100 shares tomorrow. These people will come. Idiot, you come. Now I will book profit and show you where the stock is going. Then you come and ask KP sir. Sir, I have seen this. After good results, why the stock price goes down? Because insider traders are booking profits, boss. You see, retail players are the last to react to a news. Last. Retail market participants are the last to react. They first see, like he did the analysis. Oh, volume is high. Delivery is taken. Stock is looking good. Guidance is good. But what you don't see is from 4,000 to 6,500 has already happened. No. Tomorrow they will come only with the intent of booking profit. Then they will sell the stock like anything and massacre will happen. And you buy and you see, oh my God, it was waiting for me to buy. Now see how it is dipping down. It's very interesting, yaar. Equity markets are very interesting because you spend your entire life doing it and not understand anything out of it. Generally, I have shown you the trend that there is a forward premium always in the market. I've told you this many a times in the class. So just to capture that, I intentionally gave you 3 rates going upward. Which means buyer, seller in the market for a February contract is sitting at 37,200 because he's giving you a contract of 2 months. More the time, more uncertainty. So he wants a little extra. $100 shares. You're very rich, yaar. Congratulations, sir. Congratulations. 100 shares, 37,000. Come from a rich family. How would you hedge this? You are not supposed to ask this bad questions, yaar. I can't answer right now. I have to go to options. After that, I'll teach you hedging. But I promise you by day after tomorrow, you will know all of it. How delivery trades are hedged through futures, or futures are hedged through options. Till now, I haven't told you what options I use for hedging. I'm talking one by one now. I have to look after the entire class. Should not create a negative utility. Sir, you taught so well that I did not understand anything. So I'm slowly going, I'm only talking futures right now, then I'll teach you options, then I'll merge the two and explain you how futures can be hedged through options. And how your portfolio in delivery market can be hedged through futures and options. That also I'll tell you. They can be used very beautifully. Very beautifully. You have Infosys, 1,000 shares in delivery. 1,000 shares. Somebody comes and tells you, I know 100% Infosys is going to post very bad numbers. You say, no, but I don't want to disturb my portfolio. If it goes down, it's okay. The person says like this. But what the person is not understanding is, if he's got a very short news or his analysis, okay, why always talk about insider trading? Let's say his analytical skills tell him that this time IT sector is not going to post good numbers because of some kind of economic recession in Europe and US, because the business of IT sectors comes primarily from these two countries. Sounds good? So you did your analysis and you are now fearing that I have got 1,000 shares of Infosys at the rate of 800 rupees, today trading at 1,700, although I am sitting on more than 100% of returns, but I want to build it as a long-term portfolio and I don't want to disturb my portfolio, but I have a short analytical thinking that it will drop by at least 200 rupees. How do I take advantage of this? Very simple. Keep your portfolio handy, go F- on future. You have nothing to lose. If your idea goes correct, you make money on F-. If your idea goes incorrect, then you lose on F-, but you still are okay because on your portfolio you are making money. This is hedging. Because you asked it, so on special request I told you one. But it's too early to talk all this, so I am refraining from talking all this. They can be used properly, but we have to, I feel the biggest thing that you need in the market is control on your emotions. You see how the lion behaves. He's sitting idle, he's sitting quiet, he's roaming around, he's not looking at anybody. He feels hungry, he goes, he hunts down, he eats, then he's quiet for 2-3 days. That's it. That's how you should be in equity markets. You listen to this advice of mine, you will go very far. Because I have learned this in 12 years, losing lakhs of rupees. Lakhs of rupees in this market. But I feel good about losing it for 2 reasons. I don't do the same with my clients and I give examples in class. Seriously. You become that lion. You sit quietly, aram se. You only hunt when you are hungry and when you see the market is giving you good opportunities. It's compulsive trading is something you should avoid. What you did today is compulsive trading, by the way. Just because you made money, it doesn't justify your buying the position today. You understood what I'm saying? I'm not criticizing you because first I criticized myself, only then I told you. But this is compulsive trading, which we don't understand. And people can never make money in compulsive trading. You remember me when someday in your life you will remember me for this. You agree with me, right? Because you take 10 good trades to accumulate it, you lose 1 trade and it goes. So it's always look for opportunities. Always. Wait. I'll take 3-4 minutes of yours. We'll just, whatever futures we have discussed, we'll just read a note on that, okay? Because I have given you very limited sums today, on YouTube, you will find my videos, or I'll try, if I have the link of it, I'll share it with you in the group, where I have discussed the introduction on futures. Because you don't have any homework today, so you try to listen to that video to get a good grip of the concepts. Okay, if you've understood everything, then it's not needed. Futures are standardized forward contract traded on the exchange with daily mark-to-market feature. Stringent margin requirements, high liquidity, heavy regulation, minimum counterparty default risk. You know all this, right? At the inception, it would be best, don't need point number 2, remove it. Positions in futures contract. We can take 2 positions in a future contract. Long position, we can buy future F plus long position when we are bullish on the price, expecting price to go up to square off, we will have to take a reverse position, that is short. We can sell future. We do this when we are bearish on the price and expect prices to go down. To square off, we will have to take a reverse position anytime before the maturity, that is go long F plus. The most important point that you got to keep in mind is the fact that futures in India are not delivery based. You just create a position and to square off the transaction, you take a reverse position. This is where futures are strikingly different from cash market, because in this market, even if you want, delivery cannot be given because there is nobody to give you delivery. The person taking long does not want to buy shares. The person taking short does not want to give shares. So there is no delivery possible. Why have I written this line? Why have I written this line? Some twist is there in the story. We'll discuss later. You tell. Why have I written this line that their delivery is not possible, but there is some twist in this story? Because recently some rules have changed. Don't know. Why do I message you people 3 times on last Wednesday and Thursday? Square off your position, roll over your position. Why do I do that? Because if it is not rolled over, it will not auto square off only. Then what will they do? And compulsory delivery they will give you. They will give you compulsory delivery and they will debit your account by 8 lakh, 9 lakhs. Then it will show as minus 9 lakhs in your account. Then they will charge you a lot of penalties on that. Then because you don't have 9 lakhs to give, then again they will square off your shares at whatever price is prevailing in the market. Didn't understand anything, no? Huh? I see your faces, understand. I have F plus on Reliance. 2700. Thursday. Sleeping. 3:30 p.m. Still sleeping. They will do F minus at 26.50, whatever the price is. At 26.50, you have to take compulsory delivery of 250 shares. This is because they want you to learn discipline. If you took a position, you did not square off, they assume it is implied that you are interested in taking delivery. At 26.50, they will give you delivery, plus the penalty, plus the charges, plus the interest, everything they will charge. Now 26.50 into 250, how much is that calculated? Around 6 lakh something. Okay, approximately 6 lakhs. Tomorrow morning when you get up, KP sir, small mistake happened. This is not small, bloody. This is a big mistake. KP sir, small mistake happened yesterday na, because of some, what will they say, you know, I was traveling, bad network or medical emergency. They will message me only, no, at the end of the day. I send them continuous back-to-back messages on Thursday. Or when I start from Tuesday itself. Square off. I was very busy, I could not square off. Now I see my balance is showing as minus 6 lakh. Because for first 2 days, no, balance is shown as minus 6 lakh, but portfolio also shares are not shown. Then they have their heart in their mouth. Position bhi gaya, paisa bhi gaya. Then I tell them, don't worry, nothing to panic. What will happen? They will give you delivery of shares. But sir, it's not showing in my portfolio. Wait a day. Because again, T+1 comes in. Now they give you shares at 26.50 or close to that, a little higher than that. Now what happens? You have minus 6 lakh and delivery of shares. Now to make good that minus 6 lakh, they will sell your shares at the market price. Now if that market price is 2600, then you lose another 50 rupees. Complicated process. So better before maturity, square off your position. If you are F plus, you will take F minus. No, but first he did F minus, no. So that does not make a difference, no. See, at the end of the day, number of longs and number of shorts has to be same, and number of longs have to take equal number of shorts, and number of shorts have to take equal number of longs. For everybody. How will more or less happen? More or less is happening because somebody did not square off the position. So anyways, they will square off your position, but after that, they will give you delivery. If I did F minus, then to square off, I have to do F plus. Somebody did F plus, he has to do F minus. But the number of longs and shorts that are created in the market are always equal, no? It's same only, no? You think about it. If there is nobody to take a short, how do you create a long? You can hold it? You just tell your papa, give me a check of 6 lakhs. You know, I made a small mistake which is worth 6 lakhs. What else? Small thing, boss. He's saying, can I not take delivery? You can't take. They are saying minus 6 lakh is your balance. You throw a check on the face. Take it, hey. Go. My 1 day pocket money. Take it. Generally, general population fails to pay that money within a short span of time. You are asking questions which is not a problem. Because when you have a lot of money, there is no problem in life. No. They will buy from the market, open market. Because now they are buying in the spot market and they're giving you delivery of shares. Future is over for you. Future, no, not future. Hurry. See, look at your friends. Look at your friends. Bad friends. See, I'll change my sentence. I have to be careful. Your FNO position is over. FNO position. Now they will give you spot market delivery of shares by buying in the spot market. Still not understood? It's not. Who told you this? When you do equity markets, no. You understand the risk which has been overly spoken about in equity markets is the liquidity risk. This risk is exaggerated too much. There is nothing called liquidity risk in the market. Liquidity risk is only in real estate, not in equity markets. You're saying all this, na? What if there is no seller? You just try to do a trade, you will understand there is no such thing as no sellers. Market is full and flooded with people who are trading on daily basis. I'm talking about good scripts. And anything which has FNO is a good script. It can't be a Tom, Dick, Harry script. So it does not happen like this, that I have not come across situations, very rarely I have come across situations where people tell me, no, there are no buyers and sellers. There can be buyers and sellers sitting at any price. They can be sitting at any price. When you open the screen, you see buy orders and sell orders. You know how market works. They pick up a seller at 2650 and they pick up a buyer at 2649. The least a seller is willing to sell at, the highest the buyer is willing to buy at. They connect like this. Now this person will say, okay, I'll pay this. Then this person will slash down and say, okay, I'll go with this. They're doing time pass. But finally he will say, okay, take it. Then a trade happens. And then there is an optimistic person in life. Buyer also, seller also. Buyer is sitting at 2600. In between there are lakhs of people willing to buy and sell. Then you have one person sitting at 2600, aram se. Only if it comes to 2600, I will buy. And there is a seller also. He's living in a dream world of utopia. He's sitting at 2700. Only if somebody comes to buy at 2700, I'll sell. It's okay if my trade does not go through. Okay, it will get cancelled at the end of the day. What else? Understood? But normally Indian markets, if you talk especially about Indian markets, now we have a lot of liquidity in the market. Those kind of things don't happen here generally, that you don't find a buyer or a seller. Generally, it does not happen. Those are penny stocks where all these things happen. Okay, look at this, point number 4. In India, future contracts come with maturity of 3 months and futures are not delivery based. They come in maturity of 1 month, 2 month, 3 month. With contracts starting on first day of the month and settlement taking place on last Thursday of the month of maturity. Suppose Mr. Abhishek is bullish on the stock of ICICI Bank And on September 10, he decides to enter into a 3-month future contract of ICICI Bank. Now, he would have taken a November maturity contract, which needs to be squared off by taking a short position at any time on or before last Thursday of November. But if you ask me how early can I square off, you can square off immediately also. Within 2 minutes, you can square off. You take a position, you square it off. Okay. ICAI may not respect the fact that futures have maximum maturity of 3 months. And accordingly, in exams, you can get any maturity like 6 months, 12 months, and in crazy situations, as much as 2 years. Don't read beyond that. There is a defined lot size for each contract. This is done primarily to control the traffic in derivative segments. See, in derivatives, there are always lot sizes for everything. Nifty has a lot size of 50, Bank Nifty has a lot size of 15, stocks have a lot size. For everything, there is a lot size. You want to do 25 shares of page industry. You can't do it. You do 1 lot 15, 2 lots 30, 3 lots 45. It is predefined. You can't change. Who decides all this? SEBI will decide all this, and from time to time they keep changing the lot sizes. Okay, we will continue with the discussion tomorrow. Let's stop here and just try to revise everything that I have done.